Well, hello again, Solis family. Greg Solis here with our update. I hope you all had a great Easter. We certainly did. We were down to just one child, though. Of course, Jack is out on the road doing his golf tour. He's not playing as well as he'd hoped, but he's got great spirits. He's got a great attitude, and he has all the confidence in the world that it's just a matter of time before the results follow his hard work. So he's doing well. Nicole, of course, was in Hawaii through Easter. She sent me pictures of being at two services, which was nice. She went to a sunrise service right there in Waikiki, and then she went on the north side of the island and went to another service. She said it was just absolutely beautiful. We had the privilege of going to a sunrise service as well here in the desert. Absolutely gorgeous. Loved it. Really one of our favorite times of the year for sure. And Emily was with us, and we had a great time. So kids are doing well. I hope your family's doing well also. Market-wise, boy, what a crazy time it is. I mean, we've been talking a lot about this whole inflation issue, supply chain issues. Shanghai now just has a zero tolerance to COVID, so they've kind of are shutting down a little bit, which isn't helping us. Obviously, Russia invading Ukraine has been horrible, not only for the Ukraine people, which has just been a horrendous thing to have to watch, but it was really one of the worst things that could happen from an inflationary standpoint, because that forced oil prices to go up pretty high. And that, of course, creates a ripple effect across the economy. So there's been some headwinds here. There's really been some challenges. And really the difficulty is not only the equity markets. We expect the equity markets to be volatile. That's kind of, as you hear me say often, that's kind of the price of admission with equities, is expect volatility. And peak to trough, we saw the NASDAQ down about 22.5%. We saw the S&P 500 down peak to trough about 13%. We've recovered some of that, but not a whole lot of it. So we're seeing things bouncing back a bit, which is good to see. But the challenge has been the bond market. This has been a really, really difficult time for the bond market. I remember in 1994 when I first got into the business. I got in the business back in October of 92, and one of the first brutal things I had to go through was a rising interest rate environment, and when we saw a bond market crash. And that's kind of what it reminds me of right now with this spike up in interest rates, with the 10-year treasury going from literally 0.58%, a few months back, all the way up to 2.85%. That is a substantial move. As a matter of fact, prices on bonds have been hit almost as hard as the stock market has. We saw the corporate bond index, for example, was down about 11.11%. That's a big move. And of course, the 10-year treasury down, quite a bit as well, with interest rates spiking up like that. So it only happens about 15% of the time when we go into a bear market or this size of a correction. Only 15% of the time do we get both stocks and bonds down at the same time. And this is one of those times, and it's been a pretty tough time. So it's been a challenging time as we've dealt with the bond market and the stock market. The good news is some of the so-called alternative investments, things like precious metals and gold and commodities and some of these alternative investments have held up better, which is great. And some of the adjustable rate bonds have done better as well. What we call alternative fixed income categories have done better as well. So that's helping to level out some of this volatility. But needless to say, it's been a challenging time. We think inflation is going to start settling down. We're starting to see some signs that perhaps we're plateauing here. So we're hoping that, again, the supply chain issues kind of mellow out. If the Russia ordeal mellows out in Ukraine, we think that we've probably topped out on these inflation numbers. Hopefully we'll begin to see things come down a little bit. We're seeing signs out there in some of the economic numbers that we're watching. And at the same time, earnings still look good. The S&P 500 has released quite of their first quarter earnings. 80% of them have beat earnings expectations, so that's great news. GDP numbers still look pretty strong. The economy looks pretty resilient. There's still a lot of consumers that are spending. So we are still cautiously optimistic that the economy is going to remain strong. Inflation will settle down a little bit. Of course, if the economy remains strong, that should be reflected in corporate earnings, which we're seeing, and that should eventually be reflected in higher stock prices. But again, lots of volatility. We're seeing bonds beginning to look very attractive again, especially with some of these yields that we're seeing. So there are some silver linings out there. So hang on tight. Overall, everything's in good shape. If you need us, of course, don't hesitate to call. You know we're here for you. My very best to you and your family. Take care and God bless.